Hmm. Welcome to Crescat's live market call featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please refer to our important disclosures page on the screen now. These can also be found on the description on Crescat's YouTube channel and on our website. Crescat's live market call is about sharing timely macro and newsworthy geologic updates, both positive and negative news across our holdings as they arise. These videos represent the opinions of Crescat as a mining and exploration industry advocate. Our objective is to share the overall geologic progress across our activist strategy in creating new economic metal deposits in viable mining jurisdictions around the world. If you enjoy these videos, please click on the like button and make sure you're subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on Twitter for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about our investment strategies, we encourage you to reach out to Merrick Iwahashi. His contact information is on the screen now. It can also be found on our website at crescat.net. So let's get started. This is a chart that I had showed probably 6 months ago, and it's the probability of recession according to the New York Fed's own model, and what they're and it's comparing that to high yield credit spreads. Okay, and the New York Fed's probability of recession model is one that is based on yield curve inversions, a lot like our own yield curve inversion model. We actually think ours is even better, and Tavi is the creator of it. But it's neither here nor there, because they're both saying the same thing. They're both saying that yield curves have been record inverted for a record length of time, and the twist on Tavi's is that it's a percentage of inversions across the whole yield curve, and the Fed's model is just focused on 3-month versus 10-year or something like that, just on one of the spreads. But they're both signaling a high probability of a recession, and it's been signaling this for a long time, and so this is the probability of a recession 12 months ahead, keep in mind, and it's at 58%, which is the highest it's really been in the history of this model since just a few months ago. But every other time when the probability has gotten this high or has been above 40%, we've actually had a recession. And what happens in a recession? High yield credit spreads blow out. So the spread between junk bonds and the 10-year treasury note will go anywhere from 10 to 20% above treasury yields. And where are we today? We're near record low tight credit spreads at around 3.7%. So this is a trade that we have on in our global macro fund. We've been out of this trade for a while, but we are getting back in because we do believe the probability of recession is increasing. In our view, the probability of a stock market meltdown is increasing, and we'll get to that here next. So I've been pretty busy, trading here and today, and I didn't have a lot of time to prepare a bunch of slides. Tavi was kind enough to share a bunch of his. So I'm going to talk about some of Tavi's slides today, and he's got a bunch more to share with you as well. So don't fret. So here we're looking at the NASDAQ 100 index. This is where all the mega cap tech stocks are parked, and we're comparing it to money supply, and it's just another way of looking at valuation of mega cap tech, and seeing even with the record money supply that we have out there, seeing how high stocks are valued relative to that. And valuation risk is one of the key factors in this market at the same time as we have rising interest rates, rising inflation, that we believe is a catalyst for a stock market correction, if not a much bigger stock market crash and a potential recession ahead to follow that. And we think it's of the stagflationary variety for a number of reasons, which we'll show, which we've always been showing, we'll continue to show. But let's go on to the next. So what happens in a stagflationary recession? This is looking at the 1970s. When you have rising inflation, a lot of people think inflation's good for stocks. Well, not really. Rising inflation causes shrinking PE multiples because the cost of capital is rising, and it causes valuation multiples to shrink. And so when you have record high multiples, which we have had across the S&P 500, and especially for mega cap tech stocks, and you have rising inflation at the same time, rising interest rates, it's a catalyst for shrinking multiples. And look at what happened in the 1970s, 73, 74 in particular. When you had significantly rising inflation, you had stocks falling. Let's go on to the next. Another interesting thing that we're seeing now is that as inflation expectations are starting to increase again, as reflected in the 10-year break-evens that are implicit in the TIPS treasury market, we're seeing that the correlation between VIX, which is the volatility on stocks, the S&P 500, we're seeing a positive correlation between rising inflation and rising VIX. And it's the highest positive correlation on a 52-week trailing basis that we have seen in the history of VIX or of 10-year of both of these things together. And so rising inflation expectations, rising VIX, this is not a good combination for overvalued stocks. Let's go on to the next. A lot of people are saying, but Kevin, there's record money on the sideline. Look at money market funds, record levels. And, it's true that money market funds are at record levels, but let's compare that compared to what? Let's go on to the next. Compared to the total U.S. equity market valuation, money market funds are actually at near historic low levels. Okay, at market bottoms, when we have record cash relative to equity market cap valuations, that's when there's record cash on the sidelines, like we had at the market bottom in 2002, like we had at the market bottom in 2009, not like we have today. This is not record cash on the sidelines, another risk for the markets today. I think that's probably all I have, but let's just make sure. I got one more, courtesy of Tavi again. And this is a pitch for gold. I know Bitcoin has been popular as an inflation hedge, as a hedge against global fiat currency debasement, which has been our long-running precious metals theme for years, and why we own gold and silver and gold and silver mining stocks. But what is Bitcoin? Bitcoin is NASDAQ times 3. That's what Bitcoin is. And look at the correlation between 3 times leveraged NASDAQ 100 and Bitcoin over the last 5 years. And it's if it looks like a duck, walks like a duck, and quacks like a duck, then it just may be a duck. Why does it matter? Well, gold is a traditional hedge against fiat currency debasement. That's what we're focused on here at Crescat. And we do think Bitcoin is much more of a speculative asset that has been a beneficiary of the easy monetary policy. Yes, but is it really a safe haven monetary asset like gold? We don't think so. Anyway, that's all I have. Let's go on to Tavi.
Good stuff, Kevin. All right. Well, let's there are times in macro, a lot of times the macro world sort of goes sideways for I would say sometimes years, and then all of a sudden you have something that unfolds, a war, or sometimes it could be just a shock in markets and in macro assets, and lack of volatility that, or I should say, of volume in a certain asset class that creates a shock, exogenous shocks, and so forth. And all those things usually creates an environment where creates a lot of dislocations and sort of things that we've been waiting for start to unfold. And so Kevin has been busy as well because of I think there's a lot of things that are going on right now, and those are the times that usually that I think we do our best work personally. So stick with me here, because I was listening to an interview the other day of a technology investor, and he claimed he was talking to this legendary investor, and he asked this guy, how was your asset allocation on equities exposure wise in early 2023? And he said, I was about 80% long equities. And so he asked the next question, how much were you long coming into 2024, early 2024? He said, about 40%. He took profits. And then he said, what about now? How much do you have in equity allocation? He goes, oh, right now it's zero. So, it's an interesting story. Some smart investors, they know, they don't know exactly the timing of things, but they know when things get a little frothy. So let me talk about some of the things that I think are interesting in this environment. This is a chart of commercial industrial loans, and it's going to set the stage for some of the things we're going to talk about. One of them is this chronic issue we have with treasury markets, which is at the core of a lot of the problems we see. But commercial industrial loans is interesting because it's basically sort of what drives the economy. So you have banks and they lend money to institutions. Those institutions then create growth, supposedly. And we've been through a trend that we haven't seen any lending whatsoever across commercial and industrial loans. And it begs the question, why is this happening? I showed this chart last week, and I want to sort of work through it on the reasons for that. I think the one main reason is a deeply inverted yield curve. That's number one. Banks are not incentivized in an environment where long-term yields are lower than short-term yields. It makes it very difficult for any lending institution to lend capital. And so that is one of the main things. The second thing is actually what's happening. We usually see these things happening with emerging markets. It's almost like the US and other developed economies are turning into emerging markets, believe it or not. So let me explain a little bit what I mean by that. In emerging markets, and I come from Brazil, and I've seen this many times, and not just in Brazil, it happens in China, actually, and other emerging markets too, where you have this failing business or a business that is just struggling to grow, that has become too big at some point, and now it's struggling to grow. And guess what happens during that period? The government starts to intervene. It starts to acquire higher percentages of that business over time. Now, I'm not saying here that the government owns U.S. banks, but the phenomenon I'm about to show you, it's really intriguing. Let's go to the next chart. You're seeing here in the white line that banks are starting to buy treasuries again. Now, maybe they've been instructed to do so. Maybe they're doing it in their own, desire. I just shocked to see anybody interested in buying those instruments, to be honest. But nonetheless, the white line now, you're seeing basically the ratio between the prior chart and their ownership of treasuries. In other words, today, U.S. banks have about 150 or 1.5 times more in their balance sheets of U.S. treasuries than what they have of loans. for commercials and industrial purposes. And this is, sort of fascinating because, throughout history, we haven't seen really banks have that much of U.S. Treasuries relative to, I think the 1940s is one of them. And the prior week actually talked about that, where, one of the ways to deleverage the economy at that time was really the government running a primary budget surplus at that time. What is a primary budget surplus? You take the budget deficit and you take out interest payments. And that's basically what that is. And today, it's sort of unthinkable to see an environment like that with onshoring and green revolution, defense spending. No, we're not at the end of a deglobalized environment. We're at the beginning of one, most likely. So it is sort of crazy to see that banks are not lending anymore because they're being forced essentially to buy U.S. Treasuries. And maybe not. Maybe I'm wrong. Maybe they just, again, deliberately want to buy Treasuries because they think that's there's a value proposition to be doing that. I highly doubt that's the case. Let's go to the next chart. And so it brings me to something that is contrary to the gold space, in where we're seeing gold market really take off. Gold prices have taken off and making new highs. I still remember the people that doubted the triple top, and the triple top now is past. And, we're way higher levels than we were back then. But what is interesting about this is that we're not seeing the same level of commitment coming from general investors, meaning general investors are not buying into gold. Therefore, we're not seeing a very large amount of that translating into a growth in the ETFs of the world, like GLD, which is still the most liquid ETF in the world, that is increasing assets under management. Now, contrary to the gold market, and the reason for that is because central banks are accumulating gold, not general investors, we're seeing a very opposite trend in the U.S. Treasuries, where if you look at the most liquid ETF for Treasuries, TLT, which has a long duration of a longer duration than the usual vehicles you find to invest in Treasuries, meaning they are invested in most longer term Treasury instruments. You can see here that the white line is showing that the assets under management of this instrument are still rising while the prices of TLT have been collapsing. And this is such an interesting thing because, to me, if you go to the next chart, I think the next chart has this. Oh, maybe it doesn't in this one. But even fund manager surveys are showing today that Treasuries have been one of the most overweight that they've been in many years. And this is still the case. So the general investor still carries a large weight in U.S. Treasury, despite this idea or the factual thing that prices have been declining. To me, this shows how investors are still conditioned to really be hedging their large exposure to equities, in which that legendary investor, whoever that was, said they hold 0% with U.S. Treasuries and not gold. And so gold has been sort of gone in the sidelines. We haven't seen really people use that as a form of hedging their risk. And I think we're in the process of seeing this shift, especially with the performance of gold relative to Treasuries improving drastically. Now, I went through a few presentations ago. I went through kind of what I thought was interesting to kind of break down what's causing U.S. Treasuries to rise, yields to rise, and interest rates in the long end, the short end. What is really causing all this? And, to me, if you look at the markets and the way I broke down into break evens, which is inflation expectation, there was a gap between the two. So inflation expectation, although it's increasing, it's not really explaining what's driving 10-year yields higher. I looked at the default risk in the U.S. It's also not increasing drastically, although we may have an opinion that it should be higher. The market is really not pricing that in as much as you would think. And so the last part of it was really our central banks selling Treasuries. And a lot of people like to say that, especially in the gold community, central banks are selling Treasuries. It's not true. They still hold record amounts of their positioning in U.S. Treasuries and holdings are still at record levels, believe it or not. And the fourth thing that I talked about was the flood of issuances, which I think is the more obvious take on Treasuries. Now, let me, talk about another one that I think it's sort of happening in the sidelines that I think it's going to be increasingly important, which is the risk, or not the risk, the probability of Trump actually returning to leadership. I think that is, number one, in my opinion, highly likely. I think it's probably going to be a landslide type of elections, number one. And that's why I'm paying very close attention to, what are his policies? What is he trying to accomplish? What is likely to change in the macro scenario as we see that, becoming more and more of a certainty. My view, it will be the case. But if we go back just to the 10-year yield behavior when Trump got elected, we saw an increase of about 200 basis points. It's 1.8, but it's about 200 basis points of an increase in 10-year yields at that time. Now, we were at about 1% at that era, if you remember, and today we're starting at about 4.5%. You add another 2% here. We are talking, over 6% yield in the 10-year, for instance. And I would suspect that in an environment where yields go even to 5%, let's just say I'm wrong, and maybe we just see 100 basis points rather than 200 basis points increase. What would that do to equity markets? And I'm going to add another thing here. Why does Trump, the likelihood of Trump coming in really increases or puts upper pressure on 10-year yields here? So let's go to the next chart. Well, the main reason for that is because his policies usually evolve around spending a lot of money and cutting taxes and so forth. And that has an effect on budget deficit. And so if you look at Trump, and I was actually being kind here, I took out what happened during the COVID recession, because the COVID recession basically, whacked all the numbers in the macro space, and especially budget deficit, which went to minus 20% in this chart. So let's just look at the period when Trump was elected and his presidency begins, and then what he did with the budget deficit. Now, I'm not here to say that Biden is a saint in terms of government spending, by no means. In fact, I think if he wins, and I'm wrong about this probability of Trump winning, I don't think the picture will change much in terms of spending. So that's just the other side of it. But more importantly, if I am of the view that Trump has a high probability of winning, I want to understand what type of presidency or what type of economy did he inherit when he came in 2017. He was elected in 2016. He came in 2017. Well, I can tell you there was no inflation, essentially, especially in consumers. We didn't see much of the upper pressure we're seeing today on inflation. That was a phenomenon that really happens after the COVID recession and the stimulus that came out of that and all the policies we saw coming out. So this is a very different economy than 2017. In fact, that's why 10-year yields are starting at a much higher level than it was back then. Now, if we do see him using the same strategy, which I think it's going to be remarkably similar, it's usually potential for more tariffs. I think a lot of people are paying attention to that, but really more government spending to create growth. I think the bond market is not going to like that. And I think the bond market's starting to sniff that. And I think gold is starting to sniff that too. Let's go to the next chart. And so what I believe it could happen here is maybe not an intraday movement like we saw with the BOE. If you recall, the BOE, the Bank of England, had a situation where they passed a tax cut, and the market didn't like that because they thought it was completely out of their disciplinary approach, which no central bank has that whatsoever in this era we're in. And therefore, what caused investors to actually sell UK gilts, which are their version of US Treasuries. And we saw one of the biggest declines and one of the biggest moves in that instrument in history. So I'm looking at here at the UK 10-year yield spike, as you can see there, which kind of marked the beginning of an upper movement in that trend. As you can see, the upper trend of the 10-year UK yields. I think we could see something similar to this, especially because of the amount of leverage in the system. And I think the market is starting to lose patience with the lack of discipline that we're seeing from governments overall. And to me, Biden and Trump, in terms of being disciplined and making any changes from this monetary and fiscal disorder we're seeing, I think it's basically no difference. I think we're going to see just a continuation of those trends. And unfortunately, I think this is negative for the country. But outside of my political views on that, I think that the macro environment, or what sets the stage here, is reinforcing our idea of owning hard assets and being very careful with financial assets at these valuations, as cost of capital continues to show that it's likely to stay not only higher for longer, but maybe even a little higher than it has been recently. So let's go to the next chart, because this is just the Bank of America research I pointed out, and you can see here the investors still are overweight bonds, in a large way historically. That's a little scary as well. Let's go to the next chart. And so it's an example, just looking at the GLD. I had a chart just showing the 2-year change of the assets under management across GLD, showing that really we haven't seen really general investors to start buying into gold, because once we see that, we're going to see this instrument is going to start going higher, meaning people, the general population, starts to buying into GLD or other gold assets, related assets, in order to kind of supplement their portfolios in different ways, especially given the volatility we're seeing in fixed income space, which is usually driven by an inflationary era that a lot of people are not understanding what's really going on. But that's usually what happens is inflation starts to rise. It creates volatility in the fixed income markets. And it's also going to translate into the same thing into FX markets too. But let's go to the next chart. Let's keep going. So what causes a 10-year yield rise and interest rates rising? Well, at some point, it translates into higher financial conditions. And what surprises me is that financial conditions have tightening drastically recently. Now, the way people measure financial conditions have not risen as much, which to me, and I would say to money managers like ourselves, it's an opportunity. Kevin was talking about JNK, or I should say more specifically about credit spreads and the risk of them starting to really blow out. And we see the even more of a traditional way of saying that the tightening of financial conditions is happening. And the white line that you're looking at is a Goldman Sachs Financial Conditions Index. And basically that measures, credit spreads. It measures the volatility in equity markets, the valuation, the PE ratio in equity markets. And as we all know, those things have not moved yet. Market's still expensive. Volatility is still suppressed despite the volatility increase recently. Credit spreads are in the dumps. I mean, I haven't seen credit spreads this low in probably decades. And so those things are yet to move. And the main indicator for that is the red line in this chart, which is the 10-year yield. The 10-year yield starts to rise. It causes everything basically to rise, or at least it pressures those things much higher. And so I am paying very close attention to this trend of the 10-year yield. I think, as I said, it's a chronic issue we're seeing. We're not seeing central banks buy as much as they used to relative to how much we're seeing of issuances. If we have a Trump election, a Trump president being elected, I think there is a potential for even further government spending. Personally, if that's the case, I think the 10-year yield could be a lot higher as well. Let's go to the next chart. Now, you can see here that there's a link between treasuries and 10-year yields, and it sounds crazy. But a lot of people will look at this chart and tell you that there's no correlation between where cost of capital will be and equity markets. But, I can easily see a narrative shifting towards people saying, oh, yeah, the equity markets is falling because the cost of capital is higher. And so we got to discount those free cash flows back to that discounted present value of a business. And therefore, it justifies why we're seeing a declining in the valuation of financial assets. But people are still not thinking that that's a potential or a possibility of a narrative. And it's the case just because of the AI euphoria. We've seen sort of things kind of shift And look, things can get very irrational, and they've been very irrational recently in terms of equity markets, continue to go higher despite the fact that we have, even in this case, yields proving to be, a drag on the supposedly on the valuation of equity markets. And so this is a big dilemma in the macro community. How in the world can 10-year yields continue to go higher and the market not really show even more of a painful environment? I think this is sort of coming. I think people have kind of lost their sort of their grasp for risk overall. And I think this is, personally, I would be very careful with assets that are historically expensive. And that's in particular the white line in this chart, which is NASDAQ. Let's go to the next chart. There's way better things to be buying, in my opinion. But here is an interesting thing that is happening also in the composition of the federal debt today. Now, if you look at the government debt, you can break it down into three parts, just very simplistically speaking. So you can see that there's a long-term debt. There is sort of the medium-term debt. Those are the notes that people call. And then you got the other section that is called the short-term debt, right? Which is T-bills and so forth, mostly T-bills. And what is interesting is that if you just focus on that big section, which is long-term, today it's about 12-13% of the overall debt. Now you can see this chart is going back all the way back to the 1970s. And we have never seen a time since the 1970s where the composition of long-term debt has been this high. Now, I know Druckenmiller went after Janet Yellen, and then Janet Yellen said, well, look at the duration of the debt. It's one of the highest we've seen in history. Well, the point being is that this is unsustainable, because if 10-year yields are starting to rise this way, and the government, or I should say, especially the Federal Reserve, is sort of losing a little bit of control over that, where does the Federal Reserve have control over? Usually short-term debt. So in my view, if we go to the next chart, we're probably going to see short-term debt becoming a larger percentage of the debt over time. And it's about 20%. So it's about 17% of the debt short-term is what it is relative to the overall federal debt. I think we're probably going to go to a world that we can see maybe 50%, maybe 60%. So, rather than capping 10-year yields like we saw back in the 1940s, where a lot of people talk about the yield curve control, I actually think we're going to see yield curve control happening more in the short end, and allowing the yield curve to steepen as well, and maybe carrying a much larger percentage of the overall federal debt in short-term instruments like T-bills. And I think that's probably going to be what the outcome is for the government. And this is the one reason why, we have a position in the steepeners. It's not the main reason. It's one reason. The second reason is the fact that we've been, with the yield curve inverted for so long, and usually that's not sustainable. Usually we tend to see a steepening of the yield curve. And usually the steepening of the yield curve is also a recession play, which we've seen. We've gone from everyone expecting a recession to now a no lending, which I'm going to show a next chart, I believe. If you go to the next one, next chart. Okay. Well, I don't have that one there, I guess. But anyways, maybe I put it in the wrong order. But anyways, so my point, if maybe go back to the prior chart just to finalize my point. So yeah, what I think it's going to happen, if you look at the cuts, we went from 7 cuts being priced in the curve at the beginning of the end of the year of 2023 to now only less than 2 cuts are now priced in. So if you think about that, it's 500 basis points or 5% of a move in the Fed funds expectations, right? And so to me, that's major tightening. In fact, if you look at the 2-year yield and the 10-year yield and the 5-year yield, all yields basically went up almost 100 basis points, to be precise, close to 80 bips or 0.8%. Those are very significant, tightening effects of monetary conditions in the economy that I think a lot of people are not paying close attention to. In fact, if you looked at the earnings, the corporate earnings that we measure, outside of the mega cap companies, if you look at just the broad market, even if you looked at the smaller businesses like Russell 2000, you're going to see that there has been a contraction of fundamentals already unfolding across the broad market. What it hasn't happened yet is just in the big companies. And so that, I think that there's a lot of issues that people are kind of overlooking, and the risk of a recession still here, and especially when you have the risk of the steepening of the yield curve, the what's happening with the 10-year yield, and how much we're going to see of issuances of that this year. I think there's things that people are not considering as large risk. But let's go to the next chart. Now let's talk about commodities a little bit. The Biden administration haven't officially said that, but looks like it could be looking into starting to sell some of their strategic petroleum reserves again. Well, that comes as no surprise. We have elections coming up. There's a problem here. 10-year yields, or I should say, not only 10-year yields are rising, but also oil has been rising. If you ask me, I think every commodity will probably retest the levels that we saw during that Russian invasion levels that we saw. If you looked at agricultural commodities as one example, to me, that's a roadmap for most commodities. You can see gold already doing that. Copper is close to doing that. You're probably going to see silver doing that as well. And in my view, oil is very likely to do that as well. And if we do see an environment where oil is trading at those Russian invasion levels, we're talking $130 a barrel. So if you go to the next chart, here you can see one way to kind of model this. So the red line is looking at the inventory, crude inventory in the U.S., which includes SPRs, or strategic petroleum reserves, that the government is supposed to be using at moments of a real problem going on globally. And maybe you can argue that that's what's happening right now. I would argue that's more election driven, to be frank. But as you can see here, if we're going to drive the inventory lower, in other words, sell more of our strategic petroleum reserves, you can see that there is a link between the inventory of crude versus actual crude prices. And so in this chart, you're seeing an inverted line of the crude inventory. So if the red line is increasing here, it means that they're selling strategic petroleum reserves and other types of inventories that they hold. And I'm referring to the U.S., and the white line is just showing WTI oil prices. And so there's a catch up for oil prices still to, in my view, to do. And I think that the white line could easily be trading at $130 a barrel in an environment, especially with a geopolitical premium that I believe it's not really priced in the curve whatsoever in the energy space. So let's go to the next chart. Now, another thing that somebody pointed out on Twitter, I can't find actually the source of this person who put out, otherwise I have no issues giving out the source. If somebody knows their source of this chart, I'm happy to give them the shout out for this great research, but basically showing out the Saudi Arabia current account. So basically it takes into account their current account, how much you're spending to do all these infrastructure developments and investments they've been doing recently. And how does that sort of integrate with their break even to produce oil? And you can see that their break even price is increasing. In other words, it's going to take time for them to start really increasing production as the break even price increases over time. So it's going to become increasingly difficult for the Saudi Arabia to increase their production as the break-even price starts to rise even further. So it creates even more pressure on the supply side of oil. That's really the sort of the resolution of this chart, in my opinion. Let's go to the next chart. And so one of the most important charts that I actually saw in a presentation recently from a Clock Tower group, and this is a very important chart. When I said there is no geopolitical premium being priced in oil, no, look at this chart. It's sort of fascinating how much Iran actually has been really piling on enriched uranium recently. This is, if you want a war indicator, look at this chart. And, it kind of, say, by the way, again, I'm not political at all. This is all macro data. I'm just analyzing what I think it could happen. And to me, this is a risk for Biden as well. I think this weakens his own political force as we approach elections. I don't understand why Trump hasn't used this against him, to be honest, but it is a shocking chart to look at how much Iran has increased their inventory of enriched uranium since Biden's presidency has started. And so it is a little scary chart, certainly. And I think that it's, to me, that points out as another risk for that is not priced into the oil markets too. But let's go to the next chart. So now I put out this chart together, and this is, this goes to Larry Lepar, a friend of ours that actually sent an email recently, and actually had it to his own letter. He does great work. You guys should read his letter, by the way. Go to his website. I don't remember now his website, but just write down his name on Google, and you will find his research letter he put out recently, in which he actually included some of our charts, which we're very appreciative of that. But not only that, he's got this really interesting chart that was sort of old research done that sort of shows how much was the share of the gold space, including gold itself, the market cap of gold. How do you calculate market cap of gold? Is gold above ground times the actual price of gold, and then you take the overall aggregate market cap of the gold miners, and then you add both together and you divide that by the global assets amount. So what I did in this chart, I only added the 2024 figure, in which I used McKinsey and also Bloomberg to kind of help me to find that data. And I got a number close to 1% in this, which is really interesting. If I was sort of like, was this kind of arbitrary how they choose those dates? And so I went to the gold price history, and what I found is that actually those numbers, majority of those numbers happened right before revaluation of gold. And 1981 was at the very peak of the market. 1948, there was a revaluation of gold. 1932 was right before 1933 revaluation of gold. 1921, I think there was a revaluation in 1922 or 1923. But that gives you a sense of how gold's relevance was much bigger back in those days. And today, it's sort of nothing. And I do think it's going to become a much more relevant segment of the market as we move along in the near, in this next decade. Let's go to the next chart. Silver inflows. If you looked at this weekly inflows, Quinton has such a good chart, or I should say a slide in the prior presentation where he shows, how, so you kind of have arrows pointing, you start with gold, and then it goes to silver, or it should go up. And then it goes to the miners. It kind of like how capital kind of starts flowing into those different parts or segments of the industry. And, this is just one example of showing that we've seen, if you look at the SLV ETF, the most famous silver ETF, a lot of people like to use the Sprott ETF for other reasons. I'm not going to get into that, but it still is the most liquid ETF for silver. And it's very interesting that we've seen a very large amount of inflows the prior week. If you ask me, that's the largest inflows we've seen since that period when gold and silver went crazy after the March 2020 bottom, in which we saw even the miners do something crazy. And I think the same people that are dismissing, or they were dismissing the opportunity in gold just because gold wasn't moving when inflation was really high, are exactly the same people that are dismissing the opportunity with the junior miners. So that's my 2 cents on this. But let's go to the next chart. And so, there is also a record amount of inflows coming into commodities overall, measured by the Bank of America. So I'm just showing you different types of sources that show the money is starting to flow into the hard assets in a big way. And it's yet to actually drive or re-rate valuations of things that we think will be re-rated that are still historically cheap. Let's go to the next chart. And so copper is one of our main investments as well. I think copper is going to do exactly what gold did. And it's in a very interesting sort of roadmap. If you think about gold, when gold was trying to break out from to a historical high level. And to me, this potential for shortage of energy, or I should say shortage of electricity, given what's happening. And I think Elon Musk actually has been covering this extensively, sort of talking about, he breaks down into 3 parts. It is electricity coming from heating that is changing. I mean, New York, you can't buy a stove if it's not electric stove. Those things are happening across the globe. Electric cars are also increasing electricity demand. And number 3 is, according to him, that it's going to be also even more over the years, is going to be AI. And that is not to include the actual existing demand that comes from electricity that we've seen. And so, utilities, if you looked at the estimates for utility companies in terms of their own revenues and so forth, is starting to increase as well, because people are starting to realize that there's issues happening across, I guess, the global economy in terms of the shortage of energy risk. That it will be caused by all these different segments as well of electricity demand that is going to be driven by cars and heating and also AI. But copper is sort of a fundamental sort of commodity that falls into this electricity demand and infrastructure and revamping of electrical grids. And it's likely to be one of the things that will be a way to sort of, express that view in markets today. And so I think the world where copper can be trading at 6, 7, 8, we could see that. And I strongly believe that will be the case, just like it's happening with gold. In fact, if you go to the next chart, it kind of shows this correlation between copper and gold. We all like to be cute and say, well, copper has more volatility and all that. They're basically the same chart. If you just close your eyes and you bought gold at cheap prices and you sold at high prices, you probably also bought copper at cheap prices and sold copper at cheap prices. If you ask me, if we're at the beginning of a cycle for gold, it makes me also believe that copper could be at the early stages of a movement as well. Let's go to the next chart. I'm almost done. One thing that's been happening recently that I think it's an opportunity as well, that also still is really cheap, and find it hard to believe that won't be linked to this potential for a gold cycle, is certainly what's happening with Brazil. Brazilian markets have actually been hurt recently with what's happening with also what's happening with Elon Musk and the political leadership in Brazil that has been suppressing freedom of speech and all sorts of things, and investors have started to sell some of their assets. No, I don't think this is, the fact that we even talking about that we have this level of transparency today relative to what was back in the 90s is great. I think that's actually noise relative to the opportunity I had. So to me, it's hard to believe we're going to see gold taking off and not see emerging markets also do very well, especially resource-rich economies. So to me, this is an interesting sort of a tactical but also structural opportunity over time. And if you go to the next chart, I've shown the charts of Brazil breaking out, and guess what? We're retesting that line right now. So if you like technicals, this is a chart you should be looking at it as well. I'm a big fan of Brazilian equities. I think they're one of the cheap opportunities out there, different than, and remember that AI paradox idea I've talked in the past, which I think is going to to paraphrase other experts in the space, it's going to equalize the labor market across the globe. And if that happens, the efficiency level of most Brazilian companies and other emerging market businesses is likely to also improve drastically. And that's certainly not priced in to the multiples of those companies. And so this is another opportunity. I might have one more chart, maybe not. Let's see. There you go, Quentin. It's on you now.
Okay, I'm going to coin a new term. It's Gizo. It's get your skates on. With the commodity prices here, we got to get moving, man. I'm telling you, things are turning around. It does feel a bit slow at times, but I can see the money starting to come in. We're getting a lot more incoming inquiries and whatnot. I'm sure others are as well. I talked about this 2 weeks ago. It takes time for money to trickle down through the space. I've had many discussions with people just randomly contacting me and saying, how can I get into gold? And then I have to kind of give them a 101 type lecture. I actually went in to do my taxes about 4 or 5 days ago, and my tax accountant, she said, how do you invest in gold? And, it's just astonishing. I mean, to think, that most people don't have much idea of how to even approach gold anymore. Your little yellow bar there, I think speaks volumes about where people's minds are at. And then, this Costco phenomena. Look, there's been a few articles, say in the past 2 or 3 weeks, about people going into Costco and buying gold bars, and and it's a real phenomenon. I mean, there's people doing this. They're going in and they're plunking down $2,000, and a lot of these folks are younger folks, which is really interesting. But then I've also seen just in the past week or so a myriad of articles come out from various media sources that are just absolutely lambasting this whole notion that you would buy gold. They're like, oh, well, if you buy gold, good luck selling it. You're going to get dinged or whatever. And there is truth to that, okay, but it's because we don't have a real market or structure for buying and selling gold certainly on a personal basis in the country. Okay, like in the United States, they've tried to basically eliminate gold since the 1930s. They basically blamed gold for the Great Depression, which is absolutely ridiculous. It's a metal on the periodic table. How gold could have caused the Great Depression is absolutely stupid. Okay, but they've been after gold because they just do want to see people migrate back in that direction. They don't like to see that much of the money out there tied up in gold and investing in gold and mining companies and stuff like that. And that's why I think we are where we are. But I think the tide's turning. Okay, just think about that for a minute. Costco does one simple thing. They put little vending machines out like they have, say, in the Dubai airport, and people are able to buy gold. I haven't even been to a Costco. I haven't even seen the darn things. But what I understand, people are sticking a credit card in and buying an ounce of gold. Wow. All of a sudden, it's accessible, and people who are very anxious about the world, about their situation, their personal financial situation stuff, they're willing to stick that credit card in that machine because that to them represents something tangible. It represents something real. Central banks, yeah, they get it. They've been gobbling up gold left and right and center for the past few months, really a couple of years even. But your average Joe out there is just starting to figure this out, and it's going to take a while for the generals, the population to wake up and firstly appreciate the fact you can invest in gold, but then also to figure out how you get into these successive layers of investment. Whether it's ETFs or big mining companies or, and then on down to the junior level, the exploration companies. Guess what? That's why we're here. Okay. Crescat's here because that's the kind of stuff we can do. We can make people's lives easier. If you want exposure, you're feeling nervous about things, man, come talk to us. That's why we have the get your skates on slide here. All right. It's time to get moving. Now, Tommy, I'm going to say one thing I was thinking about when you were talking about the fact that lending is kind of leveled off or even pulled back a bit. And then I thought about I think both of you made comments about yields and whatnot. Going up. I mean, the yield curve inversion is one aspect of it, but just the raw yields and stuff. And then it started to make me think, if you just step back and you look at everything that in that realm, especially in government debt, we'll say, where it's pretty easy to see this kind of stuff, it's the kind of thing that, if you read about like historical books, you read about the phenomena that people used to go through right before a jubilee, a debt jubilee. Okay. People would stop lending. I mean, that, people, when you have a jubilee coming, like within a year or two or something, the lending starts to diminish. People stop putting money out there because they know they're not going to get paid back or something. So, I mean, that's interesting. I mean, just think about it for a minute. We're not saying there's a jubilee coming, but people are, just in people are behaving like it is. Okay. And the other thing you see when the jubilee comes along is you start to see rates, yields go like crazy. Just saying, it's kind of an innate sense in humans that when we get anxious like this, especially with a large amount of debt out there, think about the amount of debt we have. I mean, 10 years ago, we were what, 10 trillion. Now we're at 34 trillion. I mean, that's crazy just here in the US. And that's just the US. I mean, look at worldwide, it's gone up similarly.
Well,
okay, so
not to steal your thing, but it's interesting, not calling Jubilee, but then banks are magically just being forced to buy treasuries is strange. And then it's the same thing as people, say, well, this is not QE yet, but the monetary base is increasing. So what is it? It's it's a definition, I guess, issue, but it's happening. I think you're right. It's
all these factors come together to create a lot of anxiety amongst people, and people's way of dealing with anxiety is to look for alternatives. And I think when you see your average Joe walk into a Costco and stick their credit card into a machine to buy a little piece of metal, and look, I love gold, okay, but it is a metal. It's a metal on the periodic table, okay? There's nothing magical about it. But think about what's going through people's heads right now, okay? There is something out there that's basically kind of stirring in everybody's minds around this whole situation. All right. So enough with the that soapbox. Let's get on and get our skates on. Let's go.
Gizo.
Okay. Yeah, Gizo. That's my new phrase. Okay. So I put together 4 slides here. They are of each of the 2 precious metal that we focus on. Look, we have investments a bit in platinum and nickel and stuff too, but gold is a big one for us. Okay. So I got gold, silver, copper, and then zinc, proxy lead as well. But basically what I'm doing here is I'm showing a picture of the gold chart over the past 5 years. Okay. And you can see the pattern that we've been in. We've been stuck in a terminal rut for nearly 5 years, just this channel going across. But when you frame it like this, and then you can see the breakout recently, it is so profound to see that. Okay. Like that, just even for a dumb geologist, you can see that and go, holy cow, gold has truly broken out. If you build a bigger picture, going back to say the 1970s, with the gigantic cups and handles and whatnot, like you showed, I think, yeah, it's even more profound. But just in the past 5 years, look at what we've seen in the past 2 or 3 months, I think since late February. And look at it compared to the behavior of gold over the past 5 years. Wow. Okay. We've broken up. Now, over here on the left-hand side, what I've done is I've put together a list of companies. Now, this isn't a thorough list of all the companies that we have, that are gold focused, we'll say, that we have in our portfolio. It is the ones that I've spoken about on videos primarily. Okay. These are companies that I've mentioned, either done like I typically do when I introduce one of our investments. I talk about the company and the basics around it, their thesis for making a discovery, what their deposit type is, et cetera, et cetera. Okay, and I've talked about all of these companies. Believe it or not, we've done 160 odd videos over the past 3 or 4 years. Okay, it's been a lot of fun. But what I'm trying to capture here is simply a picture of the stocks that we in. Most of these we still have in our portfolio. Maybe the amounts we have has changed a bit, but we have these in our portfolio. And yes, it's been difficult for the past few years, especially the past 2 years. Many of these companies have run low on funds. Okay, they've had to either stop operations or pull back and conserve cash, or both of the above. Some of them have continued to finance and go off and do their work. Some of them, have been strong stories like Snowlight, for example, where the share price has appreciated. They've been able to get that money, that capital they need, and continue to create value. Okay, but this is a pretty thorough list of the companies in the gold space that we own. All right, now I'm putting it up there because, and I'm not going to talk about each one. Okay, I'm just putting it up there because I know a lot of people kind of ask from time to time, what happened about this story? What happened about that story? Well, each one of these stories is simply in a different space. Some are low on funds and are kind of in a hibernation mode. They will come back, I'm very certain, as money comes into the space and things get going again. I'm certain these things will resurrect. Other companies in this list are still viable and functioning, like a normal exploration company. Thank God. But that is a fairly comprehensive list of the primary gold focused companies that we have. Let's go to the next slide. This is silver. Okay, the list is shorter. Oh, and by the way, I have in italics private investments. Okay. So companies that are private companies, so they're not publicly traded, but they're ones that we've invested in. We can do that here as a fund. Okay. It's one of our modes of investing. Now, in this case, you got silver. Instead of it being in a channel, it's been in this gigantic wedge for a better part of 5 years. It's like the mega wedgie, like you get in middle school and you get approached by a bully or something. But these mega wedgies, man, when they break out like they have, they can make for profound moves in prices. Okay. If you look at the kind of the delta there between that low back in 2020 and then the peak, which was actually also in 2020 ish, that's like a $12 or $13 delta, I believe, or maybe it's more than that. Maybe it's it's about $16 or $17. Okay, if this is a wedge, often you can look at that delta and you can go over here to the other end and say, okay, from the point it breaks out, it could appreciate that level. Okay, so what could we see? Well, within the year or two, it's not out of the realm of possibility. We could see $40, $50 silver. Okay, it's nothing we can promise. We're just a bunch of guys, giving our views on things, but it is certainly possible. And we like to have exposure. Again, a fairly thorough list over here. Now, some of these names you'll see in a couple of spots, but these are ones where I would say silver is a primary driver of value. Okay, and we do have some really big stories. I mean, blackjack silver. I know I haven't talked about it per se that much, but I think most people know we're invested in it. But we have a large land holding in a major U.S. Mining district that people have forgotten about, and although it's private now, when we come out as a public company, I think it's going to be one of the best silver stories, hopefully, in the silver space. I mean, this is an exceptional opportunity we were able to get into during this relatively depressed period. Okay. Then we have other stories like, let's pick El Oro. I mean, a huge, absolutely enormous silver resource that's been drilled up in Bolivia. It is silver with base metal. Almost all deposits are silver base metal, guys. Like, you can't get away from base metals. So there's very few pure silver stories out there. But El Oro is a huge silver base metal resource. Again, it's kind of been a bit in a hibernation mode. Yeah, they put their resource out last year, but they haven't had a huge amount of money. I think they've been kind of being very conservative lately, trying to watch their pennies, hopefully. But does that mean the metal's evaporated? No, it's in the ground. It's still, they're still working on it. They're still working on putting together a PEA and so forth. So I think that's one that could come, back to the fore very quickly. And it's a big silver story, guys. I mean, like, that's, we're talking, I can't remember, 200 or 300 million ounces of silver, raw silver in the resource. It's huge. Okay. Kuya Silver, they've actually decided to go down that path of getting Bethania into production. Wow, that's pretty cool. Okay, in the depressed market here, they were able to secure money through an offtake party, and they're actually building Bethania into an operating mine. I think they have a webinar or something coming up here pretty soon. They also have the cobalt area drilling, the stuff around Coeur Lake up in Ontario. Very high grade exploration up there. Very exciting. Now, Moronen's interesting. I promised I wouldn't talk about each one of these, but I'm going to touch on a couple. Okay, Moronen's really interesting because they're an ASX listed company and they've been creeping up in share price. They put out a resource. Everybody it slipped under the radar. I need to talk about it at some point in depth, but they have a major silver deposit now in the company that's going to be a very high value soon, I think, as the market turns around. San Cristobal, there's not much I can say other than wow, what a bit of good fortune for us to be able to secure that asset. To be frank, right now the mine is absolutely puking money. Okay, with $1.27 zinc, $28 silver, you want to talk about a revenue generating mine. San Cristobal is one of the best mines in the world. Okay, it's unbelievable how well it's performing. Again, it's private. Okay, you have to talk to us here at Crescat. Silver 47. Look, I talked about them a few weeks ago. They had that Michelle project in the Yukon. Unfortunately, due to permitting issues, they couldn't advance it. So they've now secured the assets from White Rock Minerals that went bankrupt in Australia. And now they have the land holdings up in Alaska that White Rock used to have. Okay, and that includes a very large silver zinc deposit, VMS system. They have one of the biggest resources in the silver space. And guess what? We're in there. We're in there at a pre-IPO level. And it's going to be an excellent story when it comes out. Western Alaska, I don't need to say anything more. It's going to be once they get going again, drilling, etc. I think it's going to be a phenomenal silver story. All right, let's go to the next slide. What do we have in copper? Look, a lot of these stories in the copper space I haven't even talked about for a long time. And I've actually had to move some of the names from the gold space over to, or gold or silver space over to the copper space. Okay, so for example, Kingfisher, most of you remember Kingfisher tried to work on a Cloudbreak property in kind of West Central BC, didn't go so well, but they have now picked up a huge land package around a porphyry copper gold system up in the Golden Triangle. It's one of the best properties I've seen in the Golden Triangle, and it's all in the hands of one company. It is a monstrous property to tackle, but I think it could have them resurrect what could be a very successful exploration company going forward into this new cycle. You got Hercules Silver, obviously, with the discovery of the porphyry copper. I've had to at least get Hercules' name onto this slide as well. Okay, Hercules, a big, very successful story. They got a lot of cash from that deal with Barrick last year, and they're going to be drilling the bejeebers out of the Hercules property here this year. So lots to look forward to. But there's other ones that look, I think are discoveries. Okay, like hands down, like BCM, no question, that's a discovery. Sergei Diakov, one of the smartest copper guys in the world, hit 100 and I think it was 160 meters of 0.7, 0.8% copper equivalent a couple of years ago. Great news at the time. Market's been terrible. Wow. Okay, but it's cheap, and they will get going again. I'm very confident that as the copper price ticks up, like you can see the breakout for copper, big wedge, just like silver, it has broken out in a profound way. $4.50 thereabouts. Copper is set to pop, and these stories, these copper stories could all benefit greatly. Like we could see a lot of these come back and appreciate in value back up to the levels we saw, say, back in 2021. Okay, now let's go to the next metal. The last one I have here, zinc. Again, it's very similar pattern. It's broken out from this wedgie from hell that's been going on for 5 years now. It is one of the strangest metals there is. Okay, when zinc breaks, it breaks hard. It can go like from $1 to $2. Like it could literally double within a year. Like it's done that several times. Like huge moves over the past 20 years. Where do I think zinc will end? I wouldn't be surprised if zinc's trading at $4,000, $4,500 a ton, which would be, close to that $2 level on a per pound basis, say within a year. Okay. And anybody that has a zinc mine, they're going to do well. And this is one of my reasons I love zinc so much. Okay. I really do. It's the most unloved metal in the periodic table. And I love the unloved. Okay. And zinc is it. Barksdale Resources has the down dip extension of the Taylor deposit. Taylor is a 130 million ton deposit, primarily zinc, going into production. S32 is dedicating $2.1 billion to develop that mine. Barksdale has a continuation of it. It's trading for bugger all. Okay, think about it. That's crazy. All right. What other companies? We got Cantex. That's Charles Fipke's company. They need to get back in the field and do the exploration work, drilling and stuff. But I think they're onto a major Proterozoic age zinc discovery, a Broken Hill type discovery. Okay, what I'm trying to say is a big darn thing. Core assets, most of the CRDs that Core has drilled, not only do they have high silver, they have high zinc. Okay, so that's a big part of their story. San Cristobal, we are one of the biggest zinc mines in the world. We crank out about a quarter of 250,000 tons, so a quarter of a million tons of zinc metal on an annual basis. If you want to see benefit from increasing zinc price, guess what? San Cristobal is it. Western Alaska, in addition to silver, just like core assets, they have huge zinc numbers in the CRD mineralization. And quite frankly, I could put lead into this picture too. I mean, lead's kind of in the similar pattern here. But so why did I show you all these metals? Well, you can see that we don't have, while we have a lot of gold companies, and we will add more, okay, but we have a modest amount of silver companies in spite of Tavi pounding the table every week, telling me more silver. It's actually harder to find silver, but we will. We're working on things. But we don't really have enough copper and zinc right now. Okay, so we are looking at these. Like I'm kind of fixated right now on finding good copper and zinc stories, and we actually have allocated some capital that we have into some copper and zinc companies here recently. And I'm going to talk about one of the zinc companies today. Okay, so I've got, we're trying to, build up that part of the portfolio and get to a point where the copper and the zinc are contributing more to this commodity bowl that we're entering. Let's go to the next slide. So what am I going to talk about today? I'm going to talk about a company called PJX Resources. This is an exploration level company. It's Canadian listed. Go to the next slide. It's one that hardly anybody's heard of, but it has been around for a while. Okay, this company has about 160 million shares out. You can see fully diluted, a bit over 200 million. So it's been around a while. It's been out there a while. We've recently decided to take a stake in this company. I think it's made a significant discovery that could result in one of the most important zinc discoveries in a long time in Canada. Okay, now this chart is a bit dated. I think soon they'll have an updated share cap table for everybody to look at, but it is what it is right now. Okay, it's trading, I think, 24, 25 cents, something like that. Let's go to the next slide. Canadian, by the way. Okay, so what the heck are they looking for? What is their target? Well, they have a land position in southern British Columbia, and I'll show you that in a minute. But they're looking for SEDEX deposits. These are sedimentary deposits. So they're layers of rock that form at the bottom of the ocean in this case. So they're sedimentary layers that the X part is exhalative, okay, meaning there were hot springs coming up through the bottom of the ocean, hot fluids that exhale zinc, lead, silver, metals like that into blankets, into layers within the bottom of the ocean. All right. So these SEDEX deposits, they're similar to VMS in many ways, but they don't necessarily have that direct volcanic association. Most of them are hosted by sedimentary rocks like muds and shales and fine grained rocks like that. And oftentimes when they are deposited, layers of almost pure sphalerite, which is zinc, and galena, which is lead, and they're mixed with muds and stuff. And then when they're brought up onto the continent, they're abducted, effectively, or brought up onto land. They often go through a lot of squeezing and pushing and squishing around where it deforms the rocks. Okay, so the image over here on the right-hand side shows you the beds of these metals and how they've been deformed. They've been squeezed and folded and whatnot. All right, but they have a feeder, so they have a hot spring feeder coming up from below, and then they have a blanket-like geometry to them. All right, let's go to the next slide. These things often form in basins, fairly big basins, that can have little compartments and different areas where these deposits can form. You can get side basins, you can get a bigger basin, like in the Red Sea right now. Believe it or not, there's a SEDEX deposit forming right now. I kid you not, at the bottom of the Red Sea. Okay, these tend to form in areas where a continent is ripping apart. It's basically pulling apart and the land is subsiding in response. And as it does, the ocean comes in and forms a big bay or a sea like the Red Sea. And then you get sediments being deposited, shales and muds and stuff. And it's in this environment where, as you're pulling it apart, heat is allowed to come up through the ground and start circulating water. And that water that pulls the zinc and the lead and other metals out of the rocks in the crust, and it moves them up to the seabed. And then they're deposited in these layers. Okay, but you can see these things form oftentimes in clusters and families, like you would see VMS deposits. So they can form in little sub-basins, side basins, and Okay, many deposits over a period of time too. Okay, it's not just like one event done. It's like one event, more sediment, one event, more sediment, more, again and again. All right, let's go to the next slide. Okay, one of the biggest SEDEX deposits in the world is called Sullivan, and it is in southern British Columbia. Okay, it's a monster of a deposit. The numbers that I've seen for it range anywhere from about 150 up to 180 million tons. In this slide here, it says 155 million tons, 5.7% zinc, 6.6% lead. So it's kind of almost an even balance of lead and zinc. Silver's there, but it's not huge numbers. But in terms of its overall endowment, that's a granddaddy of deposits. Again, this is a world-class deposit. It actually underpinned Cameco, now Teck, for a long, long time. In fact, the smelter is still down there at Trail. But Sullivan was largely mined out a while back. But wouldn't it be wonderful to find another Sullivan? Okay, you can see it's a blanket-like deposit. The reds and the oranges are the sulfides. The purpley stuff that you see going up, that's that feeder zone. You get things like fine-grained tourmaline. Believe it or not, you think gem tourmaline. No, it's not like that. It's a fine-grained black tourmaline forms in the feeders. Very distinct rock type. All right, so this is what we're looking for. Go to the next slide. Okay, so the pink arrow up at the top shows you where the Sullivan mine is. So you can see the inset map in the upper left. We're down in the southeast corner of BC. Sullivan is near the town of Kimberley. And one of the properties that PGX has is this Dewdney Trail property, the green one up in the upper right. Okay, and it's this new discovery that they have, this Dewdney Trail discovery, or on the Dewdney Trail property, that I think these guys have stumbled across our next Sullivan. Okay, that picture I showed of the model with the basin and multiple events happening, I think this is another major zinc lead event within the same basin that Sullivan formed. All right, let's go to the next slide. Now, this geologic map shows you the different rocks that we have. Okay, these are Proterozoic, so they're over 1 billion years old, just for reference. These are fairly old rocks, and they're in packages. Okay, and this Aldridge turbidites, that package actually hosts Sullivan, but it also appears to host this new discovery over here on the right-hand side, where those red and green dots are. Okay, so this Estella mine was a historic mine that was there. My view is Estella was actually probably a feeder zone for a SEDEX deposit, and now these guys have found the Sullivan type bedded deposit. In my view, I think they're onto a major discovery in basically the same kind of rocks. Let's go to the next slide. Okay, why do I say that? Now, these guys have done good old-fashioned boots on the ground work. Okay, now this area that you can see the guy standing on this very steep slope, that's a talus slope. It's basically rock that's shed down from a very steep cliff or outcrop above. That was largely hidden, obscured, and inaccessible until a forest fire came through here recently. And they were able to get in there, and they started wandering around on this talus slope above the old mine, and they found, lo and behold, chunks of bedded sphalerite, the zinc, and galena, the lead. Okay, and the pieces of rock that you can see close-ups of over here on the right in the bottom, they're folded. There's a bit of folding in there. If you have to look real close or go on their website and look real close at the images, you'll see there's bedding and there's folding in there. Looks just like Sullivan. I mean, unbelievable, uncanny. Very good tenor of zinc and lead and silver in those rocks. Okay, this is Sullivan mineralization, and it's right in the same belt of rocks as Sullivan. Okay, that's great. That's a good start. Let's go to the next slide. But guess what? They worked their way up the top of the hill and they found it in outcrop. These samples actually came from outcrops of the Aldridge type rocks, the mudstones and stuff, or shaly turbidites up at the top. And there were beds of zinc mineralization within this sequence. And they sampled this out of outcrop. That is, in my view, a discovery. Okay. And they found, several meters of this stuff up there. Okay. So basically, we have a discovery of outcrop with good zinc, lead, and silver in it. I mean, this is amazing stuff, guys, right in a district that hosts one of the biggest SEDEX deposits in the world. Let's go to the next slide. Here's a spectrum of assays from the property that they've collected. I think this includes mostly talus samples. Maybe it includes some of those outcrop samples. But it's typical grades that you see for Sullivan. I showed you the grades earlier, 5.7% zinc, 6.x% lead. Look at the numbers over here. A little bit less lead, but really good zinc numbers, I think that's fantastic. And the silver is actually a bit higher than they typically saw at Sullivan. That's great. There's even a sniff of copper in here, which is interesting. There was a little bit of copper at Sullivan. This has a bit more copper. It even has a slight sniff of gold in it. And then other trace elements, like indium was always an important byproduct out of the ores at Sullivan for years and years. So go to the next slide. Okay, here you can see their soil data. Now, they didn't get soils over everything, but you can see above the old Estrella mine there, which is in that rectangle, that black rectangle, there's a very well-defined, discrete zinc anomaly in those Aldridge age rocks, okay? And it's running hundreds, if not thousands, of ppm zinc. That says there is something big there, okay? That's to get a sense of scale. That zinc anomaly is something like 2 kilometers along strike, from northwest to southeast. Go to the next slide. Same in lead. Lead actually extends, the anomalism extends further to the northwest. But again, you have at least 2 kilometers of really strong lead values. All right. So, wow, these guys might be onto something huge. Okay, let's go to the next slide. Now, interestingly, okay, this area where this talus occurred, this stuff that shed off the mountain, has a dike, a little tiny thin red dike that runs up the dip slope or the face of the mountain. And for many years, people looked up in there and they said, "Oh, that's an intrusion. That's a magma rock. Like nothing to see here." But these guys, they found this rock in talus down at the bottom with zinc, bedded rock with zinc. Oh my gosh. So they climbed up the mountain and guess what? They found outcropping zinc in the bedded sedimentary rocks. And they said, this isn't an intrusion. This is a dike. They could see that the thing had a very shallow depth to it and that where Mother Nature had eroded through it, there was sedimentary rock underneath. In fact, there's a big package of these favorable Kootenay King deposit equivalent sediments. Okay, now it's a bit up section from Sullivan, but what did I show you in the previous slide? These SEDEX deposits occur in multiple levels within, in the stratigraphy of a basin as they form. Over here on the right-hand side, you can see the Sullivan deposit for scale. Okay, so the idea here is that could you have a Sullivan deposit where these guys have found this in that? Absolutely. Okay, and what I've done, like the orange lines are kind of hard to see, but I took the liberty of kind of sketching some drill holes about how they're going to approach this to show, they're going to have platforms stepping up the mountain and they're going to drill down through the stratigraphy to try to catch as much of the stratigraphy that's dipping off or dipping, into the ground here to find those beds of zinc. If they hit big, this could be really big, really, really big. It could be an amazing story. Very happy we got into this one. All right, let's go to the next slide. Now, have a few updates this week, not too many, and I realize time is running long, so I'll put my put my skates on for this. Okay, go to the next slide. Okay, the first story I want to talk about is Altamira. Altamira announced the first results from drilling at Maria Bonita. This is the first drilling they've done for about a year and a half-ish. Okay, this is a great story where they had money, they drilled, they had very good results in my view, and then they kind of had to hibernate for a while they didn't have much money, but they did stick their neck out, raise some money late last year, and were able to get in, and they've been drilling. and they got so what I think are very strong results from the first few holes. Okay, so I just realized how small that print is. Let's go to the next slide, and I'll try to talk about it in pictorial form. First of all, the location of this property, this Cajueiro project, it straddles the boundary between Pará State and Mato Grosso State in Brazil. So you can see we're kind of in west central Brazil. It's in an area which has other mines and stuff, other big deposits and discoveries and stuff. So it is an area that I know you can operate. It's also deeply oxidized, deeply weathered, which makes it, metallurgically, I think, makes it very favorable. Okay, and already on this property, they have a sizable resource. Okay, they have, I think it's on the order, if you add up the numbers, around 600,000 or 700,000 ounces of resource at Cajueiro in inventory right now. This is even before drilling at Maria Bonita. Okay, let's go to the next slide. All right, so where's the resource? It's mainly within that black polygon that you see kind of over here just off center. That's where the resource area is defined to date. There's room to expand it. There's a lot. This is golden soils, by the way, the colors. There's room to expand that beyond that polygon. There's some targets to the south there, Cajueiro Sul and Sossego. But this Maria Bonita anomaly is the one in the upper left. It's very discrete anomaly, and they've been drilling in the core area of that, and they came up with good results. Let's talk about it more. Let's go to the next slide. This is some geophysics that they did recently. They got some magnetics data that shows there's an area where the magnetism is strongly subdued. It's in blues in this case. And it's in this area that the gold occurs. Okay, the footprint of gold anomalism is shown by that dashed white line. Now, notice most of the drilling they've done is towards the southern end or even outside of the soil, the white polygon there, which is where the bulk of the gold anomalism is. Okay, they're now drilling to the north. Okay, so as they get more data back, they're drilling more and more to the north. Okay, that's very important for a slide I'm going to talk about in a couple of minutes. Okay, but you can see here they got some pretty good results. They got 160 meters of 0.4 grams. Within that, 31.2 meters of 0.6 grams. That's in MBA 10 over here towards the left. And then over here, you got hole 13, 139 meters of 0.5 grams, including a 28-meter stretch of 0.9 grams. And then you have hole 15 down there in the lower right, 120 meters, 0.5 grams, includes 39 meters of 0.9 grams. Okay, we're down in the southern margin, and I would say what I'm seeing here reminds me of kind of stuff around the peripheral part of the system. I think more of it's going to be towards the north. Okay, that's just my gut. Okay, so these first holes I think are coming from more of the marginal part of the system, but nonetheless, go to the next slide. They show very similar mineralization. Sorry, this is the table of results. This gives you a breakdown of the assays. Now, one of the things I want to point out here, I know the numbers are kind of hard to see. You might have to go to the press release to read them. In fact, I'm having trouble seeing them myself. But there's not a huge amount of like high grade driving these long intervals. Okay, it's a snowline type system in many ways. It's a reduced intrusive type system. What do you need to make something like this work in Brazil? Probably about a 0.6, 0.8 gram is my view. Okay, the metallurgy of this thing is fantastic. Brazil is a pretty cheap place to operate. Other mines in this region, like Paracatu, for example, I think has a head grade of under 0.5 grams. Okay, so that doesn't bother me. And the metallurgy, I think, is very favorable here. They've done a lot of test work to show it. But what catches my attention is you're not seeing a lot of high grade drive this. Okay, it's actually driven mostly by long strings of fairly uniform grade, low grade material. Go to the next slide. And it looks like this. You can see a strong lithologic control to the mineralization. So the colors of the bars on the drill holes, those are different lithologies. So what they've determined is there's certain intrusions in here, i.e. reduced intrusion, that is bringing along the gold, and it's very consistent from hole to hole to hole. This cross-section goes east-west, and it's towards the southern end of the target area. If I had to give a vector where the rest of the system where it's getting better, it's to the north. So think of the other side of this screen. Okay. In other words, we're at the southern edge, and as time goes on, we'll see what they get as they go further northward. But they are getting some pretty good grades in local areas, like down here at the bottom of hole 15. There's a higher grade stretch. Look at way down there at the bottom of hole 10. There's a higher grade stretch. These are interesting discoveries. Okay, this rock is kind of folded up and buckled up and twisted. It's not as pristine as, say, the Yukon, but it does show the same kind of pattern. Very long strings of fairly uniform grades. Okay, let's go to the next slide. Here's the mineralization. It's when you're in this pink rock, this potassically altered rock, and you see these little white quartz veins, that's where your gold is. Okay, and it's like snowline in many, many ways. It's this looks like the kind of rock you'd have it over a tombstone, a tomb, like a gravestone. Okay, now the pinkness tells me this is a big system. When you see just pervasive flooding like that of alteration through a huge volume of rock, I think we got a big system. I'm not worried in the slightest that there's going to be more going here, and we'll see more and probably higher grade values with time. Let's go to the next slide. They actually saw visible gold in little specks, very similar to what we see at Snowline in some of the veining. Okay, very small pinpoints of gold here and there. Go to the next slide. Okay, sorry, that was it. I thought I had one more slide, but anyway, the takeaway there is I think as we get more assays back from the northern part of that target area, I think we're going to see more and more higher grade results. Okay, let's go to the next slide. Sorry. Timberline announced acquisition by McEwen Mining this week. This is an example of what happens. It's a phenomenon that you usually see towards the bottom of a market when it's starting to take off again. Okay, back in 2002, 3, 4, 5, there was just this wave where one company after another was getting gobbled up. And in fact, Rob McEwen was one of the guys that was doing that in Nevada. He was gobbling up little companies and building together a pretty big land position in north central Nevada. Looks like he's ready to do that again here. Okay, now he's picked up Timberline. People have asked me, well, what do you think of this? Yes, it's a heartbreak to think Timberline was trading at 30 cents 2 years ago when they were rocking and rolling. They had drills going and moving and shaking, and now we're selling at a discount to that. But to be frank, this is a good ending for this story. I think it's ended up in good hands. Rob McEwen and his team are smart operators. They're operating their mine at Gold Bar very well lately, and I think they can advance the current resource that they have there at Timberline and get it into production. Add to their production base, but they also have ability to explore over the longer term. So I do think this is a good outcome in light of the current market. Go to the next slide. There's just a few points that I would make about this. One of the smart moves that Timberline made is they fixed the transaction value to a portion of shares of McEwen. So 0.01 of a share of McEwen Mining. So that way, if McEwen Mining goes up or goes down or whatever, Timberline will follow. But it's better than having it like at a dollar value, like a point X dollars or something like this, because if McEwen Mining comes down, if it goes up, you could lose out on some value or whatever. Like that way they track closely and you don't run the risk of losing value, I guess is what I'm saying, in the time that it takes to close the transaction. It is 162% premium, 132 over the 20-day VWAP. That's a pretty good premium, guys. And maybe that's a sign of things to come. Let's hope so. It does give owners of these shares exposure to a producing company now, which is good. It also has a copper component to it. I think that's a good position. McEwen Mining is really set to rock and roll in this new commodity cycle. And McEwen's team can advance the assets, the projects there, especially the existing resource at Timberline into production. Okay, it gives everybody more liquidity, and it also means the company does not have to dilute further, which is probably the biggest risk they faced in the current market. Go to the next slide. Okay, think this. No, I have two more. Newfound had some good news out of two targets, honeypot and honeypot and jackpot this week. Go to the next slide. Okay, they're way up to the north end on the Appleton Fault Corridor. Both targets are to the east of the Appleton Fault Corridor, and they had some very good assays, much like we've seen out of any of the targets here. Number of holes were close to or just above 100 gram meters. You can see the strike on these things is starting to grow in some cases. It's just more and more pieces to a much bigger puzzle. Okay, go to the next slide. I think the last one I have today is Puma, and I apologize, I've gone past 2:00, but here we are. Anyway, Puma put news out today, or this week I should say, about drilling to the northeast of the link zone. Okay, so they define now a corridor, and I actually like this approach because now it gives a higher assurance that there is a much bigger gold system here. They've been drilling in the link zone for the past year or two with good success, but now they have holes up in the Tiger Zone, Cheetah, and the Cheetah Zone B, way up in the northeast. They've defined basically a 4-kilometer corridor now of what are probably going to be high-grade veins. What they're trying to say in this news release, they see veining. The white bits in those core photos is the veining. That's very similar to what they saw down at Lynx. So we should expect good assays, hopefully, out of some of those holes. And this really does start to tell you that this fault corridor, just like Newfound, this is a big gold system that has some strike to it. I do hope this is one story that will turn around with this gold market. This is one I feel very fondly of, and I just love to see it succeed. So that's it, guys. That's all for me today.
Go ahead, Kevin.
All right. Thank you, Quentin. So it's been quite an exciting market these past couple of weeks. Month to date, the S&P 500's, I don't know how much it's down now, but the market's going down, and I think people have gotten it lulled to sleep, thinking that the markets only go up. But it's nice to see that gold has been holding up really good. This breakout, mining stocks have so much to go to really catch up to the move that gold and silver have already had. And especially when the small cap, when the junior exploration companies get moving, they can move dramatically more than the large cap mining stocks, than gold and silver itself. We've seen it before in other gold cycles. I think we're coming into one of those. The money's got to flow down to the juniors, though. So first it stops at the majors. First it goes into gold itself. People buy bars at Costco, and but when the money flows down into this undervalued segment, when people start to realize what great discoveries there are out there already, and what these things are potentially worth compared to where they're trading in the market today. Yeah, you have to do a little bit of homework. We help do that homework for you. That's what we're all about. So if you're interested in mining exploration, especially because that's our expertise, that's Quentin's expertise, we've built an incredible deep value portfolio that we think is ripe. People say, but the mining, the junior miners are lagging. The lag is our friend. The lag is our friend because it's okay. It means it's okay to put money to work now, because there is a lot of upside ahead, we believe. And so give Merrick a call if you're interested in learning more. Tavi, why don't you finish up?
Yeah, I was gonna say, well, Kevin, I don't understand. I love the Gizo, but I don't understand why Quentin didn't use a wedge as his intro slide. He has all these wedges everywhere on every metal, so might as well do a wedge next time. Anyways, it does certainly feel like this is there's a rotation happening, because miners, from my understanding, actually did well this week and also well today, while the market actually. And I should say it wasn't an overall market. It was very selective in technology, mostly communication services, which is basically technology that basically drove everything lower. So that was interesting as well. Anyways, we've been talking about these things for some time now, and it feels like things are unfolding now. But thanks everybody for watching. We'll be back next week with more. And if you have any questions regarding Crescat, I suggest you to communicate with Merrick, which is his contact information is on the screen. But thanks everyone for watching, and we'll be back next week. Thank you.